Every millisecond, systematic trading algorithms ingest petabytes of market data, pricing ticks, news sentiment, weather patterns, searching for a statistical edge. Most of these systems are feeding on pure noise. Deep learning architectures routinely fail in financial markets because they process raw equity returns. For any individual stock, these returns are driven by macroeconomic forces that are universally tracked and relentlessly arbitraged. There is no unique informational advantage to be found in a price move that the entire world is already watching. Consider the Brazilian energy giant Petrobras. Its daily price movements are not dictated by local corporate decisions or hidden inefficiencies. Instead, Petrobras is bound to two massive gravitational pulls: the global price of Brent crude oil and the USD to Brazilian real exchange rate. Every institutional investor with a newsfeed already tracks this dynamic. When an algorithm attempts to predict Petrobras stock from raw returns, it is essentially trying to outguess the global consensus on international commodity prices and currency valuations. Because raw returns are universally arbitraged macro proxies, trying to extract exploitable alpha from them is mathematically futile. Any persistent advantage must be found elsewhere. This equation defines the residual signal. By dynamically subtracting known macroeconomic drivers from a stock's raw return, the result is the idiosyncratic price movement. These residuals are incredibly faint, with variance orders of magnitude smaller than raw returns. Because the signal is microscopic, it is highly susceptible to statistical mirages. Random noise easily masquerades as a predictive pattern. To isolate and act on these faint ripples, MIT researcher Marcus Burgo designed a specialized framework. It serves as a theoretical blueprint for an autonomous AI inference engine built entirely around residual extraction. True alpha resides exclusively in these heavily scrubbed residuals. Capturing it requires an architecture that strictly regulates its own certainty at every layer of computation. The first step is removing the macro noise. A standard approach uses static linear regression to calculate how much a stock moves with a factor like oil. But static hedging fails when market regimes shift. This 3D scatter plot illustrates the problem. An asset's sensitivity to macroeconomic factors evolves as a long memory process. The relationship between a Brazilian equity and a global commodity realigns over months or years, rendering fixed window estimation useless. The solution is a state space formulation utilizing a Kalman filter. Instead of estimating a fixed relationship, the filter recursively updates its hedge coefficients at every time step, dynamically tracking the true relationship as it evolves. But financial returns in emerging markets like Brazil exhibit heavy tails. Standard Kalman filters assume normal, Gaussian distributions, which causes them to overreact to flash crashes and sudden volatility spikes. To fix this, the framework implements a student T robust extension. It replaces the Gaussian likelihood with a heavy-tailed distribution and employs a score-driven update to process extreme outliers. This introduces a robustifying weight into the equation. When a price innovation is small, the filter operates normally. When an innovation is massive, a true statistical outlier, the weight automatically drops, instructing the filter to ignore the observation. By utilizing a student T likelihood, the filter automatically rejects market anomalies. This mathematical robustification provides critical protection during volatility events without degrading accuracy during normal trading. Once the pure residual is extracted, any detected pattern must survive a strict triple validation gauntlet to eliminate false signals. The first two layers test the baseline. The system screens for linear association using a cross-correlation function, then tests for strict temporal precedence using vector autoregression to establish Granger causality. The critical third layer is transfer entropy. It measures the strictly nonlinear reduction in uncertainty about the future of one variable given another's past. Granger causality assumes linear relationships, but during periods of market stress, behavioral panic pathways frequently collapse nonlinearly. Standard linear models miss these genuine flows of information. To ensure the transfer entropy score isn't just a finite sample bias, the framework generates hundreds of time-shuffled surrogate datasets, testing the signal against randomized noise to verify its statistical validity. Genuine market lead-lag relationships routinely defy standard linear modeling. Validating nonlinear information flow is mandatory to isolate actual predictive edge from statistical artifacts. Most predictive algorithms output a single point estimate, for example, declaring a 65% probability that an asset will rise. This treats the estimate as certain, ignoring the structural, regime, and parameter uncertainty hiding underneath the math. The framework's core architectural solution to this is the n-depth recursive Bayesian cascade. The cascade calculates the meta-probability that the model's estimate is correct, quantifying the uncertainty of the probability itself. It achieves this by taking the base signal probability and recursively multiplying it by fractional confidences. Signal confidence, regime confidence, and model confidence are all integrated. A 65% base probability multiplied by 0.90, then 0.80, then 0.95 crushes the final effective probability down to just 44.4%. This solves a major problem in artificial intelligence. Standard machine learning architectures become dangerously overconfident as they ingest more data sources. Assuming more inputs automatically yield more certainty. The cascade applies the strong law of large numbers. As the system adds more data sources, increasing the variable universe n, the effective probability mathematically decays. Every new variable introduces a new way for the system to be wrong. The cascade structurally enforces humility. As the system's complexity scales, its effective certainty naturally and safely degrades. This crushed effective probability must then be translated into a physical capital allocation. The framework determines this using the fractional Kelly criterion. Because the input probability has been severely reduced by the cascade, the system suggests extremely small suggested capital allocations, often risking as little as 8% of capital on a single validated signal. The system continuously monitors for sudden structural breaks using Markov switching models and Hurst exponent dynamics. If a regime shift is detected, the framework explicitly models asymmetric fear propagation. Bullish signals take longer to materialize than bearish ones, so position sizes are forcefully halved to account for the speed of market panic. Outputting a microscopic position size correctly prices in both mathematical estimation error and unpredictable behavioral panic, keeping the system capitalized when its models are wrong. This introduces a logical paradox. If the system crushes individual trade confidence to a near coin flip and sizes them at 8%, how can it generate meaningful returns? The answer is the complementarity principle, extreme atomic humility paired with aggressive orthogonal diversification. This mechanism is governed by the binomial amplification theorem, which maps exactly how independent probabilities stack. Combine 10 independent bets, each with a heavily penalized 55% win rate, and the math shifts. The portfolio now holds a 75% probability of overall profitability. In empirical testing, the framework detected that isolated corn price residuals led the residuals of the Brazilian protein producer BRF by exactly 3 days. By stacking multiple uncorrelated discoveries like this, the portfolio leverages distinct informational channels simultaneously. While the cascade actively prevents individual overconfidence, the mathematics of diversification reconstructs macro-level certainty. However, diversification amplification breaks down entirely if the positions become correlated during a crisis. To prevent this, a correlation circuit breaker continuously measures pairwise correlation across the portfolio. If the average spikes above a safety threshold, the system aggressively cuts all capital allocations. Operating under these strict parameters, the framework achieved monthly returns exceeding 28% in out-of-sample backtests, running on a simulated $20,000 scale. But there is a physical limit to this design. This performance cannot scale infinitely due to market microstructure and order impact. As capital approaches institutional levels, the sheer act of executing the trade destroys the faint residual imbalance the AI just detected. The edge vanishes under the weight of the capital trying to exploit it. The pipeline is an elegant blueprint for an autonomous engine, but it is physically bound by scale, and that exact constraint is why this specific edge persists in the market.